Corporate finance practice problem using Excel. 6-year MACRS depreciation, cash flow, and net present value calculation. Get ready. It's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information on the left side, populating that into the blue area on the right side. This will be another kind of comprehensive problem, pulling together some of the components that we've seen in prior practice problems. We're going to imagine we're putting down money up front in order to get a fixed asset, depreciable fixed asset, a 5-year MACRS fixed asset for $700,000. We hope to generate future cash flows according to this stream for the next 6 years from the purchase of that fixed asset. Tax rate is going to be the 30%, and the cost of capital is going to be the 11%. You might see that called the cost of capital. It might be required rate of return. The hurdle rate could be called separate things. The new calculation here is the MACRS depreciation. Now, this is important. Note, we're thinking that the $700,000 is going down at this point in time. And if we're thinking about the acceptance or rejection of the job on a cash flow basis, why does depreciation matter? Given the fact that it is not a cash item, but an accrual item, it matters because taxes matter, and taxes are going to be cash items, so we need to think about the tax impact with regards to depreciation. When we think about taxes, not book depreciation, but tax depreciation, we usually think about the MACRS depreciation. We have to define our depreciation according to the tax code. We're going to say the property is 5 years MACRS depreciation, and that's what we will then move forward with. Remember that if you're looking out into the future, you also have to think about whether or not there'll be changes to the code, such as special depreciation, advanced depreciations in year one, and whatnot. So you got to keep that into consideration. The MACRS are kind of like the general rule as well. So you have some more kind of unknowns in the future, of course, with the tax code and possible laws that could be in place in the future. When projecting depreciation, you might want to go to the IRS website at irs.gov, irs.gov, and take a look at publication 946, which has information related to depreciation, depreciable assets. You could then go to table A1, and that gives our year depreciation. So if I'm looking at 5-year depreciation, then I can follow this percentage rates in order to calculate the depreciation. But we're going to kind of estimate it using a double declining type of method just to get an idea of what the depreciation is actually doing. That might be slightly different in the tail end, especially, and with rounding with regards to the percentages. But I want to just give an idea of the MACRS calculation, what it is, and how it might compare to other depreciation calculations. So just be aware of that. I'm going to minimize this out. Let's do our depreciation calculation. So I'm going to calculate it for year one. Double declining half-year convention is kind of the basis of the MACRS depreciation. So if the cost was $700,000, we'll pick up the 700. We're going to say the years are going to be, how many years is this for? We're saying 5 year. So I'm going to underline that, font group underline. We're going to pick up, that would be the straight line depreciation. If we just divided this out, equals the 700 divided by 5. That's usually our starting point when we're thinking about other methods. Straight line being like the default. Comparing that to the cost of the 700 again, dividing that out, we're going to get the percentage of the straight line, which we'll call the SL straight line percent. Straight line percent. 140,000 divided by the 700. Percentifying that, numbers group, percentify 20%. We don't need any decimals because it's even this time. You can also calculate that by saying this equals 1 over the number of years, 5. That also being 20%, the easy way to do it. And then we could then say, I'm going to times 2 here to make it double declining. Times 2. That's what makes it double declining, because it declines over time, and it's twice the straight line. So then we're going to take the 20% times 2. So now we've got the double D percent, double declining 40%. Now, if we took that and we multiplied it times the cost, which I'm going to call the depreciated cost, because it's basically going to be the book value going forward of the 700,000, underlining that, then we're going to say that that's going to be equal to the double D, double declining depreciation for year one. But there's a half-year convention we assume that we purchased anything in the year, not for the entire year, but like in the middle, like 6 months in. So we only get a half year. So I'm going to divide it by 2 for the half year convention. And that'll give us our MACRS Depre. MACRS Depre, then it's going to be the 280 in this case divided by 2, 140. Now you might say, hey, look, that's the same as the straight line. But remember, it's the same, but it'll only be the same because it's half year convention. So you got to realize that. Otherwise, year 2, you will calculate wrong if you assume it's straight line, given the fact that it came out to 140, which happens to be the same as straight line because it has the half year convention and is double declining. Moving then to year 2, the percent's going to be the same. We're just doing the bottom half here. Do this a bit quicker. Number group, we're going to say percent. We're at basically the book value or the depreciated cost, which was 700 minus what we depreciated last year, 140. Font group underline, multiplying this out. This is going to be the 40% times the 560. No half year convention, so same number on down below. Once again, we're going to take the 40% again. Now we had the amount last time of the 560 minus the 224, basically the book value for, tax purposes, book value. And then would be the numbers percent. And let's go ahead and multiply this out. This is going to be the 40 times the 336. And no half-year convention. That's the whole year. 40% again, making that a percent. Now we had the 336 last time minus the 144, 400. That's going to be underlined here. Underline, multiplying this out. 40 times that number, the 80,640. Now, the last 2 years, I'm going to do something a little bit different. And you can kind of see this on the schedule over here. So they kind of deviate a little bit from the double declining balance. Jumping over to our table, note that in the, what are we on? The 5-year property. Note they kind of deviate from the double declining a little bit using the same percent here. So if you were to use a straight double declining, it would probably still be okay for an estimate type of purpose. But I'm gonna adjust it a little bit. So the code kind of deviates a little bit from the straight line depreciation here. So we would say, let's continue on. This is going to be the 201 minus the 806. Hold on a second. What happened there? This is going to be equal to the 201 600 minus the 80640. And then I'm just going to use the same double declining depreciation as the last time. So that's a deviation than what we would normally do, mirroring a little bit closer to what the code is doing. And then the last one is going to be our standard type of plug, which means that we're going to be at this amount minus the 80,640 is going to give us the 40,320. Adding that up, and then if I sum up this bottom line number, that should add up to the 700,000, meaning we fully depreciated it at that time. So double declining half-year convention kind of deviated a little bit at the end here to kind of be a little bit closer to the code. You could also, of course, just use your percentages here on the code, but I think it's useful to do the double declining method with a half-year convention just to better understand what it is. So then we're going to take that and we're going to go through our cash flow assumptions. We'll do this a little bit more quickly since we've seen similar problems in the past. The new thing here being 5 years as opposed to 3 years of the MACRS. So let's do this a bit quicker. We're going to say the earnings before depreciation and taxes are going to be then equal to the inflows that we set over here, the 200. I'm going to say tab equals year 2 is going to be the 330 tab. Year 3 is going to be equal to the 210 tab. And then year 4 is going to be equal to the 190. And then tab. Year 5 is going to be equal to the 170 tab. And then year 6 is going to be then equal to the 115,000. There is that. Depreciation. We got to take into consideration on the tax basis because it has a tax effect. So we got to go, all right, depreciation. Even though we bought it in year 1 and we just paid out cash for it, we got to depreciate it over the 6 years here. And then that wouldn't even matter except for the taxes. to have a cash effect, so I'm just going to copy that across. So that makes this way more complicated than it should be, but that's okay. That's what we're paid for. Home tab, font group, underline. And then we're going to say, if it wasn't for taxes and the government, things would be easy and anybody could do it here. So they make it complicated just to pay our salary. That's why they do it. So then we're going to copy that and then paste this on down here. So there we have it. And then we're going to calculate the taxes. Taxes at the current tax rate, 60,000 times all the way over to the left here. Picking up the rate of that 30%, F4 on the keyboard, making it an absolute reference so I can copy it across. Control C, and then Control V, pasting it on down, paste it down. And then we're going to go to the font group and underline. And then we have the earnings after taxes then. Earnings after taxes equal the 60 minus the 18 year one. Let's copy that and paste it on down across. Paste it on down, Control V. Done. And then we got to add back the depreciation because it's not a cash thing. We just took it into consideration to calculate the taxes because that affected cash, even though the depreciation is not cash because we paid for it all in year one on a cash side. So we're going to add that back then. Adding that back. Underline. Line underneath. Otherwise known as underline. Cash flow then. Equals the SUM, Shift 9, adding that back in, copying that again, Control V, pasting it across. Okay, hopefully I did that all correctly. I think I did. I'm confident in myself. If I didn't, I'll let you know. If I see a mistake, I'll tell you about it. So I do have a cheat sheet here. So anyways, so we're going to do this again down here. And now, normally we do these are our cash flows. So notice you can have a very complex cash flow situation from year to year. Your goal is to calculate the bottom line cash flow here. And then we could do our cash flow assumptions. Now, this assumes that the cash flows happen at the end of the year when we do our present value calculations, which might be a bit of an assumption there. But you can see how this would kind of work, right? We got our now we got our cash flows. Now I got to do the present values because that's 5 years out. We could do that in a vertical fashion, or we could just say, let's just continue on with our table like in this horizontal methodology. So I'll just pull my cash flows on down like so, and then I'll just copy that across. Notice I like to have the years up top with just the number of the years so I can include them in the formula. That makes it easier for us to copy the formula across. Let me show you what I mean. Because sometimes I don't say it clearly, and you can't really get it unless we show what's happening. So we're going to take then the present value. Let's do this negative PV Shift 9. Rate is going to be all the way to the left. All the way to the left. I'm going to select the cost of capital now, which could be called the hurdle rate, the required rate of return. Right, that includes what we want to gain on this. And so we're going to say F4 on that, making it absolute, comma, and then the number of periods, there's that 1. See, like it moves across if I copy it across. That's why I want it up there. I don't want to hard code the 1. Otherwise, when I copy it across, the 1 will be there, and I want a 2 there next time because it's year 2 next time instead of year 1. So we have to have a 2 to reflect that. And then we'll pick up the future value, and there we have it. Let's calculate it a couple more times. And then we'll just copy it across. So PV Shift 9, all the way to the left, rate 11%. Then I'd say F4, comma, number of periods, 2, comma, future value is the 228,200. That pulls back 2 years at the present value of 185,212. Let's do it one more time, and then I'll just copy it across. PV Shift 9, rate, all the way to the left, 11%, F4, keyboard, $sign before the B14, comma, periods, 3 of them, comma, because it's not an annuity, future value, 187,320 right above it, enter. There we have it. Now let's just copy it across and do it the easy way. So I'm just going to delete these two just to show how to do it the easy way. We could have just copied and done the first one here. And because this first one's absolutized, it will not move the rate, but it will move this cell and that cell, which we want it to do. And so I'm going to put my cursor on the absolute fill handle and drag fill's handle to the right this time. There it is. Then we'll total it up. Equals the SUM on the left now, summing up leftwise. We get the 724,973. And then we'll put down the initial investment, which is at time period 0. Investment, so we don't need to do any present value into it, in other words. Negative of the 700,000 cash we put down up front to make this thing happen. The purchase of the equipment that's going to make us this money in the future. It all started from that capital investment of the 700,000 equipment purchase. Home tab, font group, underline, or it would start there. We're seeing if we want to do that, actually. Equals the sum of these two. And it comes out to a positive number. Now remember, anything positive means we cleared the rate of the cost of capital 11%. So if it was 0 even, we might consider doing it because it cleared the 11%. So that's our thing there. Let's do the same calculation vertical-like, because that's the way we've seen it in the past. So let's do it that way. It's a nice way to see it. So we can say, let's start from period 0, 1, 2, and then copy that on down, center it, alignment, center, total at the bottom, total, and then we'll say period 0, 700,000. And then we'll just pick up our flows here, which we'll pick up over here. So we have the 182, and then the 228.2, and then the 187,320, and then in year 4 the 157,192, and then year 5 the 143,192, and then year 6 to 92,596. Underlining that, putting a line underneath it, font group, line underneath, underline, equals SUM, shift 9, sum it up. That's where we would be if there wasn't time value of money calculation, or that's what we're estimating to be. But we want to now discount it back with our required rate of return, cost of capital, negative PV, shift 9, all the way to the left to find our rate. That's 11%. F4 on the keyboard, comma, number of periods now 0, comma, future value 700,000. Same number because we're at period 0, but I can then copy that down this time and just go on fill handle, drag that fill handle down, underline the bottom, font group underline, and then sum it up like so. And there we have it, 24,173. Once again, we might then calculate the IRR. We might say, hey, you know, it looks pretty good. It's above 0. So we cleared the hurdle rate or cost of capital. But what is the rate that we're talking about here? Let's just calculate the IRR because it's easy to do and fun and informative, all wrapped into one bundle of stuff. So we'll just sum this thing up, or IRR it. We're going to IRR it, in the column. And then we're going to go to the number group, percent, add a couple decimals. So we're looking 13.33% return, the IRR, the internal rate of return, the as the rooster would say. So then I'll make this black and white. So we know we cleared the rate that we wanted. What was the rate we wanted again? 11%. And we're actually at the internal rate of return of 12.33.